minutes. I actually have to defer to you, John, because I've got a tiny screen in front of me. So if you tell me what's left on the clock, we'll go from there.
I think it's got to be holding at the moment. Let's just look at the data. I haven't got the time either. Ed, you stay close.
Yeah, I see
Ed.
the hold now.
We've got a hold?
I see the hold, Jonathan.
We've got a hold,
yeah.
Okay. Ed, what do you think that means based on that hold? Is that anything to be concerned about?
There are two windows for a hold. At the 6-minute mark, on most SpaceX launch systems, they allow teams that are not running in synchronicity to align with each other. There's often a second opportunity at the 40-second mark where they say, let's take a hold, look at the systems. It can be anything from various teams managing the launch running out of sync to the onboard computers detecting an error. I don't know what it is in this instance, but it's quite normal. So let's leave it. We can come back, and we're all hoping this actually goes ahead.
Ed, the launch window, just how big is that?
The launch window is 150 minutes, and remember that because of the air clearance required to do this, SpaceX is at the whim of the FAA. They have to manage airplanes, right, flying in and around the South Texas area, so there's a clear 150-minute window. It's normal for minute-by-minute delays. Remember when you and I were on television earlier in the week, they kicked it by an hour, then they kicked it by 20 minutes, and then they kicked it all together due to a frozen pressurant valve, so anything could happen.
Ed, thank you, sir. We're going to come back to you a little bit later and return to those pictures if we do get another attempt at this. Another big step, of course, to taking people to the moon and beyond, and maybe even to Mars. Let's deal with the price action now. We're down about 0.8% on the S&P 500. On the Nasdaq, we're down 1 full percentage point. Equity futures a whole lot lower. And that's the opening bell. Let's get straight to the bond market. Yields look like this in the Treasury market. Your 10-year yield down 5 basis points, 353.94 in the FX market. Euro dollar firmer by 0.1%, 109.68. The big sector to watch at the opening bell, the financials. A host of regional banks reporting results after recording their best day of gains in a month on Wednesday. Shonali Basak has more. Hey, Shonali.
John, you have to take a look at the decline you're seeing already because you have Key Corp, which is declining pretty significantly at the open here. Net interest income was not only below expectations, they're also saying when they previously expected an increase of this year, they are now expecting a decline. And you could take a look at it's one of the biggest decliners on the day. Something interesting to ask, a lot of your guests have been talking about the risks that are not baked into the market. If you look, provisions at a lot of these banks, provisions for loan losses have been ticking slightly higher, and they're higher than a lot of what estimates show on Wall Street. I looked ahead for you over the next couple of quarters also. They're expected to continue to increase into the year, except by not that much. If economic conditions deteriorate, then do those conditions become a bigger problem for these banks? I even want to point out American Express here because it's declining at the open, and they tend to have a wealthier clientele. The provisions for loan losses there topped $1 billion. That was well over what analysts were expecting. So are we quickly turning to how quickly credit can start to deteriorate here, even if you're thinking it doesn't fall into danger territory? Is the market not baking in the risk that it could really weigh on these banks in a bigger way at a time where you're also seeing the shift in funding mix as deposits continue to be under pressure?
Shonali, thank you. Let's stick with the earnings and move away from the financials and get to Tesla. That's been a big mover this morning. Price target cuts from the street rolling in just as fast as the company's own price cuts as concerns over margins grow. Abby has more on this one. Abby, this one's sinking all morning.
It certainly is. It's in fact having its worst day right now since January 3rd. And if you recall, at that time, the stock was around $100, really with no floor in sight. And then support kicked in. But today, not so much. The 47% year-to-date rally into today, a big chunk coming out of it. It has everything to do with what you were just talking about, concerns around margins. Margins being hit by about 200 basis points on the quarter, going below 20%. This, of course, has to do with the fact that they are lowering prices between 15 to 30% on the various models, especially for the Model Y, closer to 30%, the Model S the least. And the question is, how much will this impact numbers going forward? They're making these cuts so that they can keep demand in place. Volume, it is likely, they're suggesting that volumes will stick around 1.8 million cars delivered this year. But right now, it seems that investors want both. They want the volumes and they want it to done so that margins aren't destroyed. Again, Tesla shares down about 8%, the worst day in about 3 months.
The broader market down about 0.7%. Abby, thanks for that. Dan Ives of Wedbush cutting his price target on Tesla to 215, saying this: with no rose-colored glasses, margins are now a delicate issue that are keeping Tesla investors up at night. Dan, I'm pleased to say, joins us right now. Dan, did it keep you up at night?
A little. I mean, I think, 20% margins was really the threshold. They came in underneath that, and I think that's really going to be why the stock's down here. this is not what the street want to see from a margin perspective.
Well, we've got another launch elsewhere taking Elon Musk's attention. And this is it right now, a crucial step in the goal of taking humans to the moon and Mars. SpaceX attempting another launch.
Jonathan, we have liftoff. Starship, Super Heavy booster and Starship spacecraft have cleared the launch pad. What you see on your screen is the most powerful launch system developed by mankind, heading out of Earth's atmosphere. 16.7 million pounds of thrust generated by the 33 Raptor engines at the base of the Super Heavy booster. 55-second mark, we hit max Q, the moment of the maximum aerodynamic stress or pressure on the rocket, working towards a top speed in orbital speeds of 17,500 miles per hour. This is unprecedented, Jonathan, what you're seeing on your screen. Remember, the goal here was very simple. Clear the launch tower, clear the pad. At the 3-minute mark, we expect the two stages, the Super Heavy booster and the Starship spacecraft, to separate from one another. The Super Heavy booster will then fall back down to Earth and splash down into the Gulf of Mexico, where it will sink. There will be no attempt to recover the Super Heavy booster. Starship, the spacecraft, will arc towards Hawaii and travel at an orbital height of 150 to 250 kilometers above the Earth for about an hour, perform a maneuver burn to come back into Earth's atmosphere, and then splash down 140 miles from the coast of Hawaii, 250 kilometers. They will not attempt to recover it. Jonathan Ferro in New York, Mohammed El-Arian as well. I don't know how to make this a confluence between markets, economics, and the future of mankind, but all I'll say is this is a ginormous moment for the space industry, and once again, Elon Musk has done what he said he'd do, later than he said he would, and broken a barrier when it comes to what's technologically possible for the space industry.
Ed, stay close. We'll keep running these pictures and follow this as it evolves. Dan Ives, I want to bring you back in. Elon Musk, Dan, never mind Tesla. Can you talk about this for a moment? What an effort by that man.
Look, I mean, incredible, and I think what he's done with Tesla, with SpaceX, just continues to sort of be the gold standard. And I think that's something that ultimately he's in this position of strength. And for Tesla, that's why it's also, just see with earnings, it's held to a higher standard because of what Musk has created.
We're going to return to those pictures in a moment, Dan. And for those of you at home following this, you can carry on following it in those pictures on the screen right now. But Dan, you and I need to talk about Tesla. That stock is lower. Margins are an issue. Is it keeping you up at night, Dan? You mentioned in your notes that it might keep Tesla investors up at night. Is it something that you're concerned about? And I think what everyone wants to know, Dan, you're so bullish on this company, on the leadership from Elon Musk. We all want to know what would change your mind.
Yeah, look, I think it was a concern, no doubt. I mean, no rose-colored glasses that it came under 20%. Now, look, right now they're going on the aggressive, going after market share, and I think that's the smart strategic poker move. But I do believe the next few quarters are going to be pivotal in terms of trying to keep margins around here. If you have more price cuts and this just continues to go down from a margin perspective, I think that would be a clear negative going forward. And that's why the stock's down here.
So Dan, think of Amazon early on, where the strategy was dominate, 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 put up barriers to entry to others. Would that work here? Will we look back and think that this was a smart strategic move, or we will look back and think that this was silly, that you can't dominate this market?
Yeah, Mohammed, I think it's a great question. I think here they're essentially putting an iron fence around their install base. It's an EV arms race that's playing out across the board. And, you know, it's hard to argue with Musk. I mean, essentially, Musk has been playing, you know, he's been playing chess, others have been playing checkers. And I think what we're seeing here, it's the right strategic move for the long term, but in the near term, it's a rip the Band-Aid off moment, and this is going to be transitory, what we see with margins.
Let's just build on that a moment, Dan, and talk about multiples. What I want to buy when I have a name like this with a multiple like this one is a high-growth, high-margin business, not an EV arms race. Dan, does that not resonate with you at all?
Oh, look, it definitely does in the near term. I think if we sit here a year and a half, 2 years from now, and this continues to be the narrative, then no doubt. I mean, will be a major problem from a multiple and from where the stock is. But I do believe that this is sort of a pivotal time, given the macro, to really go on the offensive, cut prices, and make sure in this sort of arms race that they put that what I'll call an iron fence around the install base, because it is an important moment. It's almost a moment of truth for Tesla, and investors really are going to now have to navigate what margins look like the next 1, 2, 3 quarters.
Just want to get an update on that attempt from SpaceX, from Ed Ludlow on the West Coast. Ed, what have you got?
Not a completely successful mission, Jonathan. We were tracking at the 3-minute mark for the Starship spacecraft to separate from the Super Heavy booster. That did not happen. Basically, the full stack remained connected, and once it reached a certain height, the combined Super Heavy booster and Starship spacecraft started falling back down to Earth, rotating in midair. At some point, an explosion was visible at high altitude while the combined Starship system fell back down to Earth. In other words, it just didn't separate. But remember, you could see on your screen at one point SpaceX employees cheering, because simply clearing the launch pad is regarded as a high degree of success for SpaceX. This mission all about gathering data. This is just the start of taking Starship from a developmental system to an operational system. So we will hear more about the technical reasons why, but we got to a certain height, the thing didn't separate the 2 stages, and then it blew up. But my goodness, that was fun.
To your point, Ed, how do we define success today? And Elon Musk himself lowered the bar quite a lot over the last couple of days, didn't he?
Yeah, you'll remember that on Sunday night he did a Twitter Spaces for subscribers only, where he just continually hammered that point. It may not happen at all, and even if it does, the principal concern was any damage to the launch pad or stage 0, because the launch pad is an essential part of the launch system. It might not be the rocket itself, but it is highly technical and expensive to develop. They cleared the pad, there wasn't any standing damage, so that in itself is a success. But the fact that they were able to get to such high altitude but not have stage separation, they will simply take the data generated, work out what went wrong, and what we're hearing from SpaceX is that allows them to plan a cadence of next attempts. We are still some way away, John, from this being sort of meaningfully operational, either carrying Starlink satellites into orbit or humans, which is destined for the back end of 2024 and beyond.
It's the first step of a much bigger, broader effort. Appreciate it, Ed, as always, and looking forward to the program a little bit later this morning, or rather this afternoon, midday, the Tech Show. Bloomberg Technology, Caroline Hyde, Ed Ludlow. Looking forward to that. Dan, I just want to squeeze in one question to you, and then I'm going to wrap things up with Mohammed. Dan Ives, we talked about margins. What on earth is going on with inventory? Why would that be ticking higher as they're cutting prices?
Well, look, I think that is definitely a question that we see in the U.S. I do think China is really where demand is starting to tick up. And that's what I view in the next month or two. That inventory is ultimately going to come down. The price cuts have sort of stabilized, and that's why in 2Q and 3Q, that's what I view as sort of an inflection point in terms of where this volume margin story starts to take the next level.
Dan, appreciate it, sir. Dan Ives of Wedbush.
Thank you.
Still bullish on the name, but just bringing in that price target a little bit. Mohammed, great to have you with us this morning.
Thanks so much for having me.
A final word. What are you focused on now going into May 3rd with this Fed?
I'm just focusing on the narrative as to what happens after May 3rd and whether they can convince the market that their forward policy guidance is credible. You know, they've been pretty consistent on telling us what happens after May 3rd, which is very little. We're going to stay there. The market and all the narrative is that's not going to happen. We've got to have these two things converge one way or the other.
Well, the data and time will take care of that at some point. Mohammed, fantastic to catch up with you, sir, as always. Mohammed Al-Arian. Coming up on this program, Secretary Yellen preparing to deliver remarks on China economic ties.
We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition.
That conversation up next.
it's important to maintain open lines of communication with China. We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition with China. And so that is not changed. We're going to continue to move forward in that way.
Secretary Yellen taking a spotlight in Washington, delivering a speech at 10:15 Eastern Time on economic times with China, writing in her prepared remarks the following: national security is of paramount importance in our relationship with the country. We will not compromise on these concerns, even when they force trade-offs with our economic interests. AMH joins us now in Washington. Morning, Anne-Marie.
Good morning, John. Well, I think what we're going to hear from Secretary Yellen is she's going to make very clear that regardless, national security interests are number one, even if it means it wouldn't be the best decision, say, if you were an economist. That's something she's going to outline today. National security interests are paramount. She's also going to talk about really a more level playing field when it comes to the economies of Beijing and Washington, that she wants to set better guardrails when it comes to that economic relationship. And third, areas where you heard Karine Jean-Pierre, the president's press secretary, talk about where to engage. And on that, it's going to be climate change and also debt sustainability. And already, Jonathan, we are seeing this administration try to take a warmer tone on opening up an avenue for engagement. We saw that from Secretary of State Blinken at the G7 foreign ministers meeting in Japan. Also today, we have U.S. Ambassador to China having one of his first meetings with a senior U.S. official since February. So you could see potentially Secretary Yellen here is setting up for her own trip to Beijing.
AMH, and also I'd say this, just given who we're talking about here, the former Federal Reserve chair, we're seeing this Treasury Secretary transform into someone who is willing to put politics before economics.
Well, I don't think the Treasury Secretary would call national security interests politics, but to your point, and I really go back to the tension in the administration when inflation was very high last year, and they had a decision on their desk, and that was whether to ease some of the Trump-era tariffs or keep them, double down, because of national security concerns and that leverage that those tariffs still would provide. And at the end of the day, the administration went with national security concerns, and Janet Yellen is coming out today, and she's backing that.
AMH, thanks for that. That's the latest from Washington. Just getting that headline that we can confirm, that we all basically saw, that SpaceX Starship exploded after a failed rocket separation. Ed Ludlow's going to cover that for you a little bit later. Also happening in Washington, the debt ceiling debate heating up, and it's the president versus the speaker.
Mega Republican in Congress are threatening to default on the national debt. They say they're going to default unless I agree to all these wacko notions they have. America is not a deadbeat nation. We meet our obligations.
Today, I'm proud to announce that we are introducing the Limit, Save, Grow Act of 2023. President Biden has a choice. Come to the table and stop playing partisan political games. Or cover his ears, refuse to negotiate, and risk bumbling his way into the first default in our nation's history.
Back with us, Mike McKee. Mike, we need to talk about this, don't we? I think we're all trying to gauge, based on the returns, the tax returns of the last week or so, where that ex-date might fall. Mike, where is it?
Well, right now it is at the beginning of June, and you know, John, there's an old saying in Washington that you shouldn't watch the sausage being made, but what happens if the sausage doesn't get made? That's the job for the Treasury and the Fed. Treasury keeping a closed mouth on what it would do, but for the Fed we have some ideas looking back at what they had done in the past. Now you see in the markets already some kinds of reaction. We got only $108 billion in tax money on Tuesday when it was tax day. The analysts I'd spoken to said we needed somewhere between 150 and 200 billion. And so if we don't get enough in the next couple of days, it looks like we're going to move up the date for what is going to happen. And markets are already reacting to that. There's a big kink in the yield curve now, with rates at the 1 month level way down, because everybody wants in on that, because you know you'll get paid. But then you go farther out on the curve and they rise significantly because people don't want those securities because they might be disrupted. What is the Fed's going to do about it? They're going to have to discuss that probably at the May 3rd meeting if we are pulling forward the date of the possible default. And they, in 2013, John, met and discussed a number of different ideas, including repos, reverse repos, ways to basically keep the system going. They want to make sure that people realize that what they're talking about is keeping the Treasury market open, not helping the government fund its debts.
Mike, just one more thing on tax day. There was a delay for California. They got an extension. Do you think that plays into some of the smaller than expected numbers that we've had?
It probably does, because the 108 billion came in much lower than people had anticipated. The thought was 150 wouldn't be a very good number. So we're obviously missing a lot of money, but would California make up $50 billion? Probably not. So unless we get some additional cash coming in, and there will be some over the next few days, then the date moves up. The question is, can they last until June 15th when quarterly tax payments come in, and that would maybe push it out till August. But right now, it's beginning to look like you got to take the 1st of June seriously.
Mike, thank you, mate. 1st of June. I wonder when this market starts to carry in a bigger way. Mike McKee there on the latest. Your broader market right now, 22 minutes into the session, negative 0.6% on the S&P and the Nasdaq, down 0.5%. In the broader bond market, yields are lower off the back of jobless claims data earlier. We're down 7 basis points on a 2-year to 4.17. On a 10-year, we are down to about 3.54. We're down 5 basis points there. Let's get you some sector price action. Here's Abby.
John, well, what's really amazing here is that 0.6% decline. It's the worst day in about a month. That really speaks to the slow melt up that we've had. Not surprisingly, then, with this sort of a decline, we have most sectors, all sectors at this point, lower. Utilities down the least, that defensive sector, energy and consumer discretionary down the most, down about 1% or more. Banks in the middle, down 0.4%. On the year, though, it's all about consumer discretionary being higher, a piece of that being Tesla, which of course is down today, but higher on the year. The banks, though, down 16%, a real divergence there between tech and the financials.
Bit of weakness this morning at the surface level, at the index level. Abby, thanks for that. More broadly, we're down by about 5 or 0.6% on the S&P. Up next, your trading diary, a ton of Fed speak to round out the week. 25 minutes into the session, equities lower by 0.6% on the S&P. On the Nasdaq, recovering just a little bit. We're down 0.5%. That's the price action. Here's the trading diary. 10:15 Eastern. 20 minutes from now, we'll hear from the Secretary of the Treasury, Janet Yellen, on US-China relations, plus Fed speak. Waller, Mester, Bowman, Logan, Bostic, Harker throughout the day. Rounding out the week with US PMIs on Friday, going into the quiet period for the Federal Reserve. Looking out to next week, more earnings on deck. First Republic on Monday, followed by Alphabet and Microsoft on Tuesday. On Thursday, Amazon and Intel report, and we get another US GDP report. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, April 20th. Here are the top market stories that we're following for you at this hour. Tesla's margin dent. You got Elon Musk leaving the door open to more price cuts, dragging global auto stocks down. What a price war could mean for the markets. And a mixed deposit picture. You got a slew of regional banks out with numbers and a murky deposit landscape. We're going to break that down for you as well. And the DOE lets the sunshine in. We talk exclusively to the chair and CEO of Sonova on his company's $3 billion loan guarantee from the government and
how it can help spread more solar panels across the U.S. The stock popping by about 2%. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Danny, we are under some pressure here in the markets. You have jobless claims rising just a little bit. Obviously, there are areas that are under pressure, like autos and potentially housing.
Yeah, well, we did just get data now coming in, Alex. Let me bring it to you, of U.S. March existing home sales coming in at 4.4 million. That's a 2.4% growth. It is ever so slightly weaker than the estimate, which was 4.5 million, but it basically is in the middle of the range of those we surveyed from Bloomberg. Alex, it is some strength that we did see in pending home sales feeding through, but the question we keep grappling with is the consumer strong? Are they still buying those big ticket items?
Yeah, and to be fair, you know, D.R. Horton is up like 7%. They had better than expected second quarter results and guidance. Have we already kind of hit the low for the housing market, and then we're kind of moving back up? And our auto is really getting hit because of Elon Musk, not necessarily a broader underlying issue. I don't know. We'll break it down.
Well, the concern is that if Tesla, a car company with immense brand loyalty, has to cut prices, is that a bad leading indicator for the rest of the corporate world? And Alex, that brings us to our question of the day. Has Tesla started a pricing war? Is every automaker going to have to follow suit now? Joining us to discuss is Bloomberg's Detroit bureau chief David Welch and Stefan Nicola in Berlin. David, let me start with you. I think Elon Musk himself would probably hate this question because he said before, you're covering it wrong. We're not starting a pricing war, but is he to some degree? Is this going to ignite a pricing war?
Well, he said it's not, so that's the last word, right?
Of course.
No, so look, he's got a lot of different dynamics that I think other car companies don't. If you look at first quarter sales numbers for all the car companies, they did pretty well, and pricing held up pretty nicely. What Tesla has going on is, one, he is fighting for market share, and I think demand is softening for their vehicles. Their inventories crept up from 3 days worth of vehicles to 15. 15 is not a lot, but Tesla never really carried inventory. They don't have dealers with big lots full of cars. You order a car, they deliver it. And their revenue growth has gone down 5 quarters in a row now. So he's dealing with a couple different things. In addition to that, Berlin and Austin, Texas plants are not at full capacity yet. He's still ramping those up. That means he's going to have even more vehicles that he's going to have to try to push in the coming quarters. So I think he's got softness, he's got capacity coming online. That's not the same situation other car companies are in. That doesn't mean they won't get pulled into a pricing battle, but he's got some different dynamics that he has to wrestle with.
Okay, fair enough. So, Stefan, when I'm looking at all the traditional OEMs, auto companies, are they down because of Tesla, or are they down because of Renault, or why are they getting hit so hard today then?
Yeah, well, you know, Elon Musk may say that Tesla hasn't started a pricing war, doesn't want to start one, but what we can't ignore is that Tesla's moves has repercussions all over the auto market. They're still the EV market leader, so what they're doing on EV prices will affect all other companies. If you know, I may take you down to France. Renault this morning reported sales that in the first quarter that beat analyst estimates, and it confirmed its full year guidance. But the shares still slumped today, the most in more than 6 months, because of concerns overpricing that Tesla started. So, you know, you just can't ignore what Tesla is doing. It has repercussions all over the auto sector.
And Stefan, one of the points that David made that I want to ask you about is this idea of the different dynamics that automakers are facing. Tesla is able to, at scale, make profitable vehicles. How in danger are the Renaults of the world if they need to start cutting?
Yeah, of course, Tesla still has sort of industry leading margins, especially when it comes to EVs, even as they've been decreasing a bit. Renault is in a way different position. You know, its margins are way lower. It's producing cars that are generally lower priced. Its main market is Europe, where we have inflation concerns, we have high energy prices, a cost of living crisis. So, the concern at the lower end of the spectrum is a bit higher. But we also have to know that not just Renault is falling today. It's Volkswagen, it's Stellantis, it's BMW, it's Mercedes. So, lots of companies are affected by the pricing concerns.
Focusing on Tesla for a second, David, and Stefan made the point that the margin room is obviously so much nicer and bigger for Tesla, right? Like 11% versus, say, a 6%. But nonetheless, the margin re-rating is going to have to come with a valuation re-rating too. Like, you can't have the valuation that Tesla has if the margins are coming down. How are you going to look at the two?
So Tesla has traded as sort of a super premium luxury car company for a long time because their vehicles are very expensive. They trade at multiples even higher than Mercedes and BMW. So I think that's what we may be seeing right now is with the softness in demand and lower pricing for them, lower margins. I think they're going from what was this hot growth company and this technology story to something that is maybe more like a car company. And you notice on the call yesterday, Elon tried to talk about autonomous driving and full self-driving as a way that would bring in more revenue and more business. He talked about stationary storage, which has nothing to do with cars. That's about storing energy on the grid to make a case that they're not just a car company. But right now, the way the shares have been trading down 10% in the last 3 trading days, the market may be starting to perceive that. I do think they will drag pricing down for electric vehicles in the U.S. market especially. But do they drag down pricing for gasoline-powered pickup trucks and SUVs? They don't make one, and there's a lot of pent-up demand for those vehicles, so I think there could be staying power in pricing. But overall in the U.S. market, pricing has to come down because we've been at record levels for a year. It just can't stay that way forever.
David, will this ignite calls for Elon Musk to concentrate more of his time on Tesla? Just moments ago, we saw the SpaceX rocket launch. It appears that it exploded. There's the concerns about Twitter. Do the calls for Musk to come back home, if you will, get louder?
Well, they may, but I think when you invest in Tesla, you have to realize that this guy has SpaceX, he's got Twitter now, he's got the Boring Company, he's got all these different things, and you sort of buy into the story that he can balance all of these different things. And I think so much of the value of the products themselves and the stock is tied up in his genius and his brand name that there aren't going to be calls for him to really change much, and he'll ignore it anyway.
Yeah, I was going to say, when aren't there calls and when he doesn't ignore it? Hey, Stefan, last word to you. When you take a look at the auto space, which auto company is set up best to defend itself if Tesla is triggering this price war?
Oh, that's a tough call, but obviously the ones I think on the top end of the spectrum, the companies that have luxury cars and can charge luxury prices, Mercedes-Benz comes to mind, Porsche comes to mind, BMW to a certain degree, they may be shielded a bit from those pricing concerns, at least to some degree.
All right, guys, thanks a lot. Really fun conversation. You're looking at S&P up by 0.5%. It was really seeing GM, Ford getting hit hard here. David, Stefan, thank you both very much. All right, coming up, we're going to take a look at the market repercussions of a Tesla price war. Also, what does it say about the cycle and how much downside then could there be in cyclicals? Linda Dussel, Senior Equity Strategist over at Federated Hermes, joins us next. This is Bloomberg.
we see inflation moving into the rearview mirror. The Fed is going to want to make sure this inflation really gets down. So I think the idea that they're going to pivot is a mistake. I think they're much more likely to pause, hold rates at an elevated level, and continue to see the economy decelerate. That's going to create further tightening.
That was Blackstone Group President and COO Jonathan Gray joining Bloomberg TV earlier today. So let's get to the question of the day, because it also kind of has to do with inflation. Has Tesla started a price war? Linda Dussel, Senior Equity Strategist over at Federated Hermes, joins us now. You know, Linda, I know you don't talk specific names, but if we're in like a price war for EVs, in a weird way, is that deflationary? How do you look at that?
Yeah, sure, it's deflationary if you're a consumer and you're looking to buy an automobile. And as we know, in these last couple of years with COVID, first you couldn't find a car, and then there were too many cars. You know, there was a glut of used cars, et cetera. And so now we have Tesla basically saying we'll sacrifice margins in the name of using this factory space that we have. So as long as the consumer still has money, then yeah, that's a blessing. That's a piece of disinflation. And they'll probably take them up on it, too.
Yeah, exactly. Tesla, of course, has all of its own issues to deal with, as does the EV space in general, Linda. But I wonder if you look at this and say, okay, maybe this is the first sign that corporates are losing pricing power.
Well, it's definitely a strong sign, yes, that corporates are losing pricing power. And it's one of the reasons why I think we're stuck in a wide trading range now here for 6 months and counting. You have to really pick your spot. You have to really study your companies to get the sense of whether they have something that consumers or whomever their customer is wants, that they can keep those prices up, because some of their own costs will be stubborn. And, you know, and that's one of the first things to watch really on the downside of an economic cycle, is that margins start to get hit. Now we really need to watch sales and make sure sales are okay, because you can hurt your margins, but if your sales stay up, then your earnings per share may still be okay.
Right, which is probably what, you know, Elon Musk is betting for on that, which kind of leads me to the broader impact, right? So how does this affect the broader market? I'm looking at Ford, I'm looking at GM. Those stocks are getting hit really hard. Those cyclical guys. How does that feed through to the overall index?
Yeah, well, of course, now the overall index has been, one of the reasons why that it's been stuck in this trading range is because it's heavily weighted in terms of the largest names. And the largest names, and this is particularly in the tech sector, which arguably you could call Tesla a tech stock, they've held up well, though, on the norm. And so one thing to be concerned about as we get deeper into this earnings season is that next week we're going to hear from more cyclical stocks and more tech stocks. So that should be a really interesting week to watch the earnings season progress. I know that cyclical stocks in general have been bid down already now to as low as what they were back in October. So a lot of the air should be out of them. So why would you think a surprise on the downside is a surprise, you know?
Do you think then that perhaps equities, I mean, they really, along with treading water, just defying gravity when we have a market that's expecting a recession? It goes back to this thing that Bank of America said, Mike Hartnett, that we're over-optimistic on the likelihood of cuts, but not pessimistic enough on what would cause the cuts. Do you think this market should be pricing in something more of a recession?
Well, we think that the stock market is pricing in a mild economic recession, which is kind of what we at Federated Hermes expect. And what makes it difficult in terms of how to navigate a market, you really would like it to move somewhere. You're not happy when it sits there, is that we have something, I saw a word just the other day called, I thought was really cool. It's called slowflation, a slow economic growth rate. Slow growth, maybe 1% GDP this year or next, and that's what we're suggesting. And then inflation that stays stubbornly higher than what the Fed wants. And that's what we think the next number of years may hold. So you will want to pick your spots. And if the Fed pauses, you still want to be in defensive stocks. That's what history tells you.
What's the difference between slowflation and stagflation? They sound the same.
Well, a slowflation is you're having an economic growth of some kind. You're having a slow economic growth. You're not dragging into recession. If we have a technical recession, which we do, priced into the back 2 quarters of this year, we still have a full year of 1%. That's slow. If next year we don't see any big bounce or any big decline, then that's slow. If we're seeing this disinflation that we spoke of with Tesla, that's good. And as you mentioned early in our talk here, the housing market seems to be reviving. That's not stagflation, nor is stagflation unemployment at these low levels.
I think that is such an excellent point, Linda, and it's a point that perhaps doesn't really have a clear playbook. We talk about the 70s, whether that's a corollary, what to do in that stagflation scenario. So how do you think about positioning? How do you think of what becomes your guiding star if we enter an environment like that?
Yeah, sure. I mean, if you were in the mindset of slowflation, then you'd say, well, what worked historically? And what worked historically were these same defensive sectors that, interestingly, year to date, up until this month, were underperforming, and you're starting to see the staples, the healthcare, the utilities maybe poised to come back to life again after being beaten up a little bit, and importantly, the energy sector coming back. If you're expected to be stuck in a range and you don't see good catalysts outside either which way, you should look for income. Defensive, quality, dividend-paying stocks have been beaten up for you in the first quarter of this year while everybody was running over to the big cap tech stocks, and so now you're getting some good prices too and some good yields. That's the smartest thing we can think of. Plus cash.
So Linda, just one more quick question, and because you mentioned housing, and I wonder, I know you saw it slowflation, but if we just look at housing, it's not only that it bottomed, but it also feels like in some areas it's re-accelerating. Like you just look at D.R. Horton, as I mentioned earlier. I mean, the selling season's off to a good start. Yes, okay, maybe they had home buyer incentives, but are we going to re-accelerate areas of the economy that already got beaten up a bit?
Yeah. And as you spoke of, when we compare ourselves to the 70s, look, I was around in the 70s. We were trying to buy our first house in the 1970s. The affordability was ridiculous even compared to what we see now. So I feel for these young people who should have been buying in the last 15 years, but it's not nearly so bad. What makes this possibly, at worst, a slowflation is the demographics of this country, where there are more 32-year-olds in this country than any other age. Crime, dying to get someplace to live. And if I may, when you speak of slowflation, I was just reading that apartments will be completed this year, 2023, at the highest level in 40 years. That's going to be great news for inflation in the rental piece of CPI.
Interesting. Oh, certainly. Yeah, that demographic demand piece of it is so fascinating. Linda, thank you so much for joining us today. That's Linda Dussel, Senior Equity Strategist at Federated Hermes. Coming up, the inaugural unmanned flight of SpaceX Starship ends in an explosion. There's just some good pictures there. Minutes just after the launch, Elon Musk says a lot was learned for the next test flight. We're going to have more next. This is Bloomberg.
The call-out, next, do now.
experts, great questions.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Angel Feliciano. A mixed bag of results for AT&T. The phone giant reported free cash flow that missed estimates in the first quarter, but said it's on track to meet the full year forecast. Meanwhile, the company added more monthly phone subscribers than expected. Home builder D.R. Horton reported better than expected orders in the first quarter. Tight supplies of existing homes drove buyers to build sales officers. While D.R. Horton's orders dropped 5% from a year earlier, they were still 73% higher than in the previous quarter. And another sign the slump in computer chips isn't going away. Taiwan Semiconductor forecasts worse than anticipated revenue for the current quarter. Apple's most important chip maker warned that demand from the mobile and PC industries would remain soft for now. And that's your Bloomberg Business Flash. Alex?
All right, Angel, thanks so much. It's 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond. And Silicon Valley starts its morning, and well, we're watching the SpaceX explosion that just happened in the last hour. Joining us now from Seattle is Bloomberg Technology co-host Ed Ludlow. Ed, they said the Starship experienced rapid, unscheduled disassembly. What does that mean?
It means that at an altitude of, I think, 29 kilometers above the Earth, the structural integrity of Starship, both the combined entity of the booster, Super Heavy booster, and the Starship spacecraft, something went wrong. And the main takeaway is that there was no stage separation. The plan after the 3-minute mark from launch was that Super Heavy booster would detach from Starship spacecraft, and Starship spacecraft would continue for about an hour at an altitude between 150 to 250 kilometers above the Earth. And it didn't happen. There was no separation. And what you saw in the pictures was the combined Starship system falling back down to Earth, rotating in midair, and then there was an explosion. But this was a success for SpaceX, and from their point of view, this launch really exceeded expectations.
I just have to say, next time I break something or have an accident, I'm absolutely calling it a rapid, unscheduled disassembly, absolutely using that myself. Ed, can you get into this idea that this was still a success? What did they learn? What's important here that they were able to achieve?
So like in the first instance, all they wanted to do was clear the launch tower for a number of reasons. You know, Elon Musk really deliberately set the bar low here in terms of what they were trying to achieve, because they've never tried to launch the Super Heavy booster before combined with the Starship spacecraft. The reason that clearing the tower is important is, say it had exploded and not launched successfully, that could have had a really big impact on the launch pad itself, caused damage, which is expensive, but it also delays further tests. And we know that Musk has tweeted that the next test could be a couple of months away. The reason it's a success and they got to high altitude but not to orbit is that the data generated helps with the cadence of continued testing. Think about how far this has come from an idea back in 2005 to now. It's not a smooth arc when you're developing a technology for a launch system. So they will take this as being exceeding expectations, and they'll find out what went wrong and hopefully next time address it.
You mentioned the next couple months. What do you think happens between now and then?
They try again. I mean, remember, the goal here was not even to try and recover the booster. So with Falcon 9, the Starship, the SpaceX vessel we're most familiar with, they land the booster back down on Earth autonomously. In this case, had they reached orbit successfully, they planned to dump the booster into the Gulf of Mexico and splash Starship down off the coast of Hawaii. So that gives you some reality of where we are. Longer term, the idea is to reach orbit, do a sustained orbital test, and longer term, 2024 and beyond, Starship is the commissioned system from NASA to return mankind to the moon. So these are incremental steps, but they are substantive as well, because they're just part of taking Starship from a developmental system to an operational space system.
Yeah, it will be fascinating to see how quickly they can get another test up and running. Ed, so wonderful to talk with you today. That's Bloomberg Technology co-host Ed Ludlow, of course, monitoring that spaceship launch out of Seattle. Those pictures really, really incredible. Now, coming up, it is a huge day of results for regional banks. We're going to look at what the data tells us about lending and deposits. This is Bloomberg.
We're about an hour into the U.S. trading session. Equities trading a little heavy here. Abigail's tracking the moves for us. Abigail?
Yeah, Alex, it is definitely starting off a little bit weak here. We have the S&P 500 down about 0.5%. We have the NASDAQ down a little bit less than that. Moments ago, the S&P 500's worst day in about a month, which really speaks to a little bit of the slow melt-up that we've seen. But these are two of the big pressures on the various indexes. Tesla down 7.5%. Its worst day since January, although off of its lows. Of course, this as margins come in light and investors and analysts are worried that that may be the trend. They want not just the volume of cars sold, but they want it done whereas pricing and margins, earnings aren't pressured terribly. AT&T down 8.6%. The last time I looked, it was down less than this, and it was the worst day in almost a year, so it could be a worse day than that even. Free cash flow missed in a big way, plus they're talking about weakness in the wireless segment. Now, one thing, another pressure on stocks overall, even though the indexes are off the lows, they could be yields. Now, yields on the day are down. The 2-year yield down about 9 basis points, so you can see this little bit of a round trip. But over the last 4 days this week, we certainly have yields higher, and that could bring back into question valuation. Speaking of rates higher, we just got existing home sales data, and it was a decline. So the contraction that we've had over the last roughly 14 months, more than a year now, it is continuing. If we go into the Bloomberg terminal, we will see here is the decline in existing home sales for the month of March after a big pop-up, a surprise pop-up in February, even though we've had 2 months of prices going lower. And then, interestingly, in contrast to existing home sales, well, D.R. Horton up 6.7%. They put up a tremendous quarter right across the board, suggesting there's really not a slowdown for new homes, or maybe these home builders, Danny, have managed it well, but you can see the entire sector getting a bit of a lift.
Yeah, Linda Dussel talking about the demographic component. That just means that housing demand isn't going anywhere. Abigail, thank you so much. That's Bloomberg's Abigail Doolittle. Now, elsewhere, Blackstone's profit slid as deal-making was hit by rising interest rates and banking turmoil. President and COO of BlackRock, Jonathan Gray, joined Bloomberg TV earlier to talk about what he sees going forward.
We're actually in discussions today with a number of regional banks to partner with them. I think the private credit area is really at a golden moment because we do see tightening out there, and yet we have this large pool of capital to deploy, and so I think you'll see us become much more active.
Well, there was Jonathan Gray. He mentioned regional banks. We're going to talk about all of it with Bloomberg's Shonali Bassick. Shonali, to start with Jonathan Gray, because of course you were speaking to him there, what were your takeaways?
There are a couple things here. If you look today, Blackstone shares are up on the day, even though assets under management were a little bit below estimates. And Danny, one reason could be they have $200 billion nearly of dry powder. That means if things get cheaper here in the market, they can buy things at pretty attractive rates here, and some really key businesses that have some secular, wind to them include credit markets. And remember, we spoke to John Gray and others as well, frankly, about this idea as credit starts to contract in the economy, firms like Blackstone can get in a deeper way. And if you take a look at it, the jump in the stock prices of a Blackstone or an Ares, which by the way have brought in a lot of institutional investor money from, just their funds alone, but also their stock prices, they're both up more than 20% on the year on the back of that thesis.
So I was also reading that we don't know how much these investors are going to want to go in and buy debt of the regional banks. They don't really know if the crisis is 100% over, so they don't want to load up too much. But knowing what we know now about where deposits are and earnings, is the worst over?
It's a great question today because remember, it looked like an all clear or something yesterday when you saw a set of banks come out. But today is a lot messier. If you look at it, we have companies like Zions that are down more than 6%. The worst performer in the KBW Bank Index, KeyCorp, I wanted to point out also because it's down pretty significantly. And the problem is not only deposits. KeyCorp says deposits will be flat to lower, but for all of these banks, Zions, KeyCorp, Comerica, is not just deposits, but also net interest income. KeyCorp in particular, I want to point out, saying NII for the year is expected to decrease. Previously, that was expected to be an increase. So you certainly see lending under pressure at certain mid-sized and smaller banks. I also want to point out here, because remember, people are so focused on the regional banks that they have not focused as much on the big credit card companies. And American Express is the worst performer in the Dow Jones Industrial Average right now, and it's because a lot of the market had expected, know this is leaning towards a wealthier client. They're not going to see the same types of pressures on some of that client base. And, frankly, you do see spending volumes jumping, particularly for the Platinum card, but provisions for loan losses were a stunning $1.1 billion, which was hundreds of millions more than Wall Street had expected.
That's, to that point, we're talking to Cole Smead yesterday, who said exactly that. He likes that richer people, that this is what the product catered toward. Clearly, that still has some issues. Shonali, when it comes to deposits, do these regional banks have any clear path forward to make sure they can hold on to them and don't lose out on competition with the big banks?
If you believe John Gray and you think that, rates will stay high for a little longer, they're not going to be necessarily cut this year, then you definitely have that pressure, that movement away from the deposit bases into more money market funds and higher yielding places for consumers to go. And remember, some of these banks are already guiding that deposits will be flat or lower. That was certainly the case for the likes of KeyCorp. Comerica missed on deposits. That deposit issue is causing a lot of pressure when you look at its return profile, too, for a lot of these banks. It's not just a matter here, Danny, of worries about really deposit flights. It's not a bank run kind of worry you're looking at when you look at these regionals. Now you're looking at the kind of pressure they could face on profitability throughout the entire year, because without that deposit funding base, then their net interest income, their net interest margins are even further under pressure than you might have initially thought.
Yeah, look at Comerica, as you were saying. All right, Shonali, thanks a lot. Bloomberg Shonali Bassick joining us. We're going to have more in the banking industry as well. Bloomberg Wall Street Week host David Weston will be joined by Bank of America Chairman and CEO Brian Moynihan from the Sell-Side Leaders Forum. That's happening here at the Bloomberg headquarters. We're going to bring that to you live on Bloomberg Television at 2:30 p.m. New York time. Coming up, we'll actually continue this conversation and also talk about solar. A new Biden administration loan program is going to bring solar energy to some disadvantaged communities. There also could be a regional bank knock-on effect, too. We'll get the perspective from the CEO of Sonova Energy, John Berger. This is Bloomberg. The government is joining forces with Sonova Energy that installs solar panels in your home and then helps provide services to help you manage your demand. Now, the DOE is backstopping about $3 billion worth of consumer loans. It's about 90% of the total, and those loans will be packaged off to investors. With us now to speak an exclusive interview is John Berger, Sonova Energy President and CEO. John, listen, congrats. $3 billion is a very large number. The total amount of loans is $3.3 billion, so this encompasses 90%, and that's a nice backstop. John, walk us through the process to getting here, and what are you going to use those loans for?
Well, thanks for having me, Alex. Yeah, we're very excited about this. This is groundbreaking, and it really is a needle mover in a big way for not just Sonova, of course, but for the entire industry and the entire country. So, what this does is it opens up the funnel top as far as the number of and type of customers. So for low, moderate income customers and made in specific reference to Puerto Rico, which has been a market that we initiated and started over 10 years ago now. It really expands the availability of our service to a number of people that would not be able to have our service, especially in this type of environment that we've gone in. The second thing is the cost of capital has been reduced, and we're aggregating all these homes and providing that clean power that's in excess to the communities as well. So it does quite a lot, like I said, for Sonova, the industry, and the country.
Talk about the consumer part of this, because you mentioned lower quality consumers, but let's just dig into that. We're not talking really bad credit scores, right? There's still going to be some accountability here. I'm just worried about sort of the longer term effect of that because interest rates are rising, for example.
Yes, I wouldn't say it's lower quality. What I would say is that they, some folks, we've all been there, have sometimes difficult times, particularly as more people are getting laid off, right, Alex? And that's what the Fed is looking for, is they're raising rates. And so, this is a way to counterbalance that. Look, one of the bills that you sit around at the house that you do not cut is the power bill and the water bill. And so what we're able to do is provide more affordable, more cleaner, more reliable power to these folks. And so this is really just folks that have had struggles with health bills or an auto bill or maybe a mortgage that got too high. Not folks that just can't pay any bills at all or anything else of that nature. But that's very important in this environment as the credit has gotten tighter with the failure of Silicon Valley Bank and so forth on the community bank side of things. This fills that void.
Yeah, okay, so good point on that. So what has been the effect? We're now, about a month out from what happened with SVB. What has been the effect in the solar community and the clean tech energy community in terms of that fallout and cost of capital increase?
Well, we have built, and it's one of the key reasons why Sonova, why the Department of Energy chose us. First and foremost is we're focused on service and making sure the power flows for our customers. So we have a command center in our headquarters building in Houston, and we deploy our service technicians across the country to make sure that power flows. And then secondly, if you look at our software platform, it's able to really go out there, not just take the homes and integrate them in the grid, but tell the homeowners when there's going to be higher carbon power that's being produced by the utility. So use your power that Sonova is providing you. It does that automatically. The last is that we have a strong balance sheet and cash flow statement, the strongest in the industry by far. And we have traditionally gotten our money from the asset-backed securitization market, institutional, so insurance companies, pension funds, et cetera. And so we didn't have much exposure to community banks, credit unions, as some of our competitors did. That capital has largely dried up. And again, what we're seeing is a huge amount of growth where a lot of the contractors, a lot of the customers are coming to us, and now we have that further augmented by, again, having this DOE loan guarantee. We can step in and we can, again, broaden our reach, increase our growth, and address more customers. So it was really the right thing at exactly the right time with regards to the capital markets.
Hey, John, Danny here in London. Great to talk with you today. The other big macro elephant in the room is the geopolitics of it all. China and U.S. relations. You have the IRA trying to bring more of the renewable energy industry back onshore, back to the U.S. John, as things stand, considering the U.S. solar energy depends on Asia manufacturers, about 80% of its annual panel supply, Can any place replace China?
Absolutely. United States of America can replace China, and we're doing it. There's a lot of capacity additions as far as for wafer cells, particularly modules. Obviously, batteries is a big a part of this as well. But those announcements have already been made. All the companies that we buy panels from, at least the vast majority, either already have capacity here in the States and are expanding it rapidly, or have announced capacity additions in the United States or are about to. And so this is something that we think that when you go and look at the Inflation Reduction Act, it doesn't matter what you think of it, but it is having a material impact and bringing, and it should, bringing the solar and battery industries, which have become national security important to the United States.
But John,
so absolutely.
But John,
yes.
Isn't that going to make it, at the end of the day, just more expensive? What's your counter to that?
Well, it doesn't have to. So there's a lot of incentives in the IRA to the manufacturers, but there's also a lot of incentives to our customers that we can pass on to make it even cheaper still on top of that. And I do think that there's much to be made of, too much made of, hey, China's cheaper. China's been getting more expensive for a long period of time, as we all know. And so, yes, there is some cost increase, but that's mitigated, if not eliminated, by the IRA. And certainly over a period of time, I think that we'll be able to have cost parity with anybody in the world.
John, how long would it take for the U.S. to replace China? Seems like a big pull, a big load at this point, considering where the industry is.
It's going to take some time. Look, you always shoot you straight. Look, this is not going to happen overnight. It's not going to happen next year, but it is a ramp. It's not that you have to wait 5 years and all of a sudden the capacity shows up here, but it is a ramp, and it is a steep ramp at that. And what I would also say is that, you know, it's something that as we bring these technologies here to this country, where in many cases we invented them, we're going to be able to have more innovation here. So we're going to be able to do some things that we can't contemplate as far as cheaper, newer technologies on the solar, on the battery, and the controls for demand for homes and businesses. So how do you lower that power demand? That is really taking off. And then electric vehicles as well, and the chargers, which we supply power to our customers through providing power service to their homes and businesses. So there's a lot of innovation that's going to happen that's going to accelerate this.
John, in the very short term, the House Ways and Means Committee is trying to undo a 2-year moratorium on tariffs on China, on products coming from China. Are you worried about that? Does that affect like your very short-term view here?
Well, I don't think that's very good policy at all, to say the least. We've got to give some time for the industry to respond. The incentives are in place. Companies like mine are deploying billions of dollars of capital to make this happen. So the train's rolling fast down the tracks already. That would be extremely counterproductive for, quite candidly, just some political points. And I'm not really sure that they're that good political points at the end of the day. This is happening. We need to give it some time to make it happen. What I would also stress is that because the panels that we buy are what we call high efficiency, or the higher end, and yes, we pay more for them. That's been true for years and years and still is. It will not be us that is really impacted. It will be the utilities that will be impacted. Anything in front of the meter, so the utility scale industry will be disproportionately, by far, negatively impacted by this. So I think that some of the utilities and the unions of the utilities will be very involved in this and making sure that American jobs, and that's what's at stake here, American jobs for the utility scale industry are at risk if that is indeed passed and signed by the president.
John, a really fascinating insight, and of course I would expect nothing less from a fellow Berger. No relation, by the way, in case anyone was curious. John, thanks so much for joining us. John Berger, Sonova Energy Chairman, President, and CEO. Coming up, tax day bringing in just a paltry $108 billion to the U.S. Treasury. We'll explain how that's going to impact the debt ceiling debate next. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. The first flight of SpaceX's Starship rocket ended in an explosion minutes after launch today. That complicates Elon Musk's goal of sending humans to the moon and to deep space destinations such as Mars. SpaceX suggesting that simply blasting off could be considered a success. Musk tweeted that a lot was learned from the flight and there will be another test launch in a few months. Outside Paris today, protesters angry over French pension reforms stormed the entrance hall of stock exchange operator Euronext. Railway workers and others chanted, set off flares and waved union flags. Euronext says operations were not affected. Anger over President Macron's decision to raise the retirement age from 62 to 64 remains strong. And tax day brought in a lackluster $108 billion to the U.S. Treasury. That adds to uncertainty about whether or not the U.S. will make it through to late summer without risking a debt ceiling-related default. As of April 18th, the government had about $252 billion on hand to pay its bills. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex.
All right, Angel, thanks so much. Let's get more on the tax receipts and also how it feeds into the debt ceiling. Bloomberg's international policy and economic correspondent Michael McKee joins us now. All right, $108 billion sounds like a lot of money to me, but what does it mean for the Treasury in terms of the debt ceiling?
What it means is it may pull the date forward. Things are getting real now. The Treasury had estimated that they would go to about June 5th before they would get close to what they call the X date, when they can't guarantee that they could pay all of the government's bills. We're finally seeing the politicians start to pay attention to it. Wall Street already paying attention to it. And one of the things they were watching was whether or not we paid a lot of money in taxes on tax day this year and filled up the Treasury's coffers enough to push the X date back. Doesn't look like it. Only $108 billion, as Angel just said, which is not going to be enough to get us out of June. Now the question is, can they get to June 15th when quarterly tax payments come in, and that might give them a little more breathing room. And of course, breathing room is important to give the politicians time to work. But the markets are already starting to notice this. We've seen credit default swaps for the United States start to blow out, and the yield curve has gotten this interesting kink in it where the 1 month bill yields are way down because people want that bill because they know they'll get paid, and the same pretty much with the 2 months. But if you go beyond that, there's a question about whether you will get paid, and so yields have really risen as prices have fallen because nobody wants those bills. And I mentioned the yield curve and the CDS at this point. Interestingly enough, you look at the 1 year credit default swap, and it is higher now than it was back in 2011 and 2013 when we had the last crises. Maybe this suggests that Wall Street's a little bit more worried about it this time because the two sides seem farther apart. And it's not just Wall Street that has to worry about it, it is the Fed. Now back in 2013, the Fed got together, had not a secret meeting because they did put out a transcript of it, that discussed what they would do in the event of a debt default. So we don't know what they'll do this time, but dusting off that playbook would mean they would do things like they've done in the past couple of crises to try to keep the markets operating, buy securities, lend securities. They could roll over debts, and obviously banks could go to the discount window. They might offer repos and reverse repos if rates go way up or way down based on scarcity. In an emergency only, they might buy the defaulted debt out of the market, or they might just swap, if you have a defaulted bond, swap you a bond that is not defaulted. But that was what Jay Powell called loathsome, those ideas. They don't want to do that because they don't want to be seen as getting involved in the politics of a debt default. And they made it clear in 2013 that all this would be done at market prices. So if the debt went down because of the debt default, then they wouldn't be giving people par like they are with the banks right now.